Good morning, everybody, and welcome to yet another week. It's the last week for the month of Feb. Actually, days are really pushing very fast. But nevertheless, today I just want us to debunk about risk to reward ratio, because you have to understand that risk to reward ratio won't save you when you have bad trades, right? So the key thing here is to help you as a trader to be able to stop you from hiding behind the good risk to reward ratio while ignoring a trade quality. Yes, I know you might be having maybe probably 60% losing trades and 40% winning trades, but still you're profitable because of the aspect of the risk to reward ratio. But in this particular video, I want to show you why risk to reward ratios don't save you during bad trades. So just talk with me and you'll be able to understand. For instance, what I'm talking about here is that if you have maybe probably a 1:5 risk to reward ratio, that won't save you from won't save you a bad trade. Okay, so if the setup has low probability, a big target doesn't make it smart, it just makes it optimistic. All right, I believe now you get what I'm talking about, because many traders believe that as long as their risk reward ratio is strong, they are trading correctly. So it's okay if I lose. For instance, my RR is 1:4. But remember, risk to reward doesn't create an hedge. It only amplifies the hedge. Okay. So in this particular video, I'll explain why focusing on RR without probability keeps traders stuck and what actually matters. So this video is for a trader who is obsessed over 1:3 R or 1:5 1:5 RR setups, justify weak entries because the reward looks big, and also believe that risk to reward ratio alone guarantees a profitability, or probably they struggle despite the good math. Okay, so if your reward target looks impressive but your account doesn't, then this video is for you. And here is the key shift that I want you to have: that risk to reward ratio is a multiplier, not a filter. So it does not make bad trades look good. It only enhances good trades. So there is this misunderstanding about risk to reward. And what we need to understand, basically from this misunderstanding, how it functions, that risk to reward ratio tells you how much you are risking and how much you aim to gain. Okay, that's true. We know that risk to reward ratio will tell you how much you're risking and how much you're willing to gain. But remember, it doesn't tell you how likely the trade is to win, whether your entry is aligned, or if liquidity supports the move. It doesn't tell you that. Therefore, you can have a 1:10 risk to reward ratio setup, beautiful target, tight stops, and still lose consistently. Why? Because probability wasn't on the risk to reward ratio, right? So, and the math that most traders ignore is what I'm going to share here, but let's simplify it first of all. For instance, if you take 10 trades, right? If you take 10 trades, so, and each with a 1:5 risk to reward ratio, but only 10% win rate, you lose money. Okay, so higher risk to reward ratio does not compensate for low quality entries. What it does is that expectancy matters than reward size. So the formula isn't just a risk to reward. The formula is win rate times average win minus loss rate times average loss. Okay, so the formula isn't just about taking risk to reward ratio setups 1:10, 1:5. No, the formula is basically your win rate. You multiply by your win, your average win, then you subtract your loss rate multiplied by loss average loss. So without probability, therefore, RR is meaningless. So why traders hide behind the big targets? Because you realize that large risk to reward ratio setups, they feel attractive because they look impressive, they feel professional, and they justify taking marginal trades. And therefore traders say that even if it's low probability, the reward is huge. But low probability means more losing streaks, more emotional pressure, more rule breaking, and more drawdowns. Eventually, confidence now collapses. Big targets don't protect psychology. Good entries do. What actually makes a trade high quality? Before calculating the risk to reward ratio, ask yourself, has liquidity been cleared? Is structure aligned? Is this the right session? Is there confirmation? Is timing correct? Again, structure, liquidity, and time, very, very important. So if those are weak, then risk to reward ratio doesn't matter. So if the liquidity has not been cleared, if the structure has not aligned, if it's not during the right session, if there is no confirmation, if the timing is wrong, therefore risk to reward ratio does not matter. So you can have a setup of 1:2, all right, risk to reward ratio, trade with high probability. That means it's a stronger than a 1:6 risk to reward ratio trade based on hope. Okay. So what I mean here is that you might have a trade of risk to reward ratio of 1:2, but with high probability. This trade is stronger than a setup that has 1:6 risk to reward ratio based on hope. Why? Because quality comes first, reward is second. Okay, so when risk to reward ratio when risk to reward ratio actually works, or what are the instances that risk to reward ratio actually works, you realize that risk to reward works best when the entry is precise, stop placement is logical, probability is established, and structure supports continuation. So in these cases, or in those cases, risk to reward ratio amplifies the edge, but it cannot create one. Right? So why am I sharing this? Because initially I used to hunt setups of big risk to reward ratio like 1:5 setups constantly. But what I didn't realize that was that I was ignoring the context and convincing myself that the math would save me. But once I prioritized on probability over reward size, then consistency improved. So I started looking at small targets, better execution, and healthier equity curve. Okay, so in summation, or in summary, what am I talking about is that you need to understand risk to reward ratio does not make trades good. It enhances good trades. And a strong risk to reward ratio with weak probability is still weak. And therefore, as a trader from today, start focusing on liquidity, structure, timing, and confirmation. Then optimize on reward. Why? Because trade quality should come first. Then math about risk to reward ratio should come second, right? So in the next video, I'll be talking about the difference between patient and hesitation in trading, because waiting for the right setup is powerful, but waiting out of fear destroys opportunity. So until next one, keep safe.